The recent cut in interest rates has been welcome news for homeowners, but for some it's come too late. A new study has found that 40% of people who bought homes just after the global financial crisis are facing mortgage stress. Many will have no choice but to sell because their houses are worth less than their mortgages. Tracy Bowden reports.
It's upsetting that I'm leaving my home. This is where I brought my children home after having them and stuff, and all those types of memories.
When Cassandra and Matthew Rouse moved into their house in Newcastle, north of Sydney, they expected it would be home for many years, the place they'd raised their family. Instead, they're packing up and moving out.
The best decision for us to make was to sell the property, get rid of all our debts, clear slate and start again.
Like thousands of other Australians, they discovered that what seemed like a manageable mortgage became anything but. A growing family and the spiralling cost of living changed everything.
For us it was very tight. We couldn't go out and enjoy ourselves as a family. We had to basically count every penny we had.
Credit and Debt Hotline, Alex speaking.
The family sought help from solicitor Alexandra Kelly at the New South Wales Consumer Credit Legal Centre.
What sort of loan do you have?
Every year the centre receives 17,000 calls from people who need advice, many of them struggling to meet their mortgage repayments.
What a default notice is it gives you 30 days to pay the arrears. I think there is a real optimism that people generally have that things won't go wrong, and when they do go wrong, there's very rarely a plan B.
Many people put their head in the sand and hope it'll go away, relying on the Reserve Bank to cut rates.
Banking analyst Martin North has studied one group which has been hit especially hard by mortgage stress: people who took out loans immediately after the global financial crisis.
Of the 400,000 first-time buyers who entered the market in 2008 and 2009, 40% of those are now in some degree of difficulty, and about half of the 40% are in now the more severe end of mortgage stress, may have to refinance, perhaps have to sell the property. I'm not talking here about low-doc loans, or I'm not talking about flawed lending policies or anything like that. I'm talking about standard meat-and-potato loans made to first-time buyers who ticked all the boxes in terms of affordability and those other factors at the time.
In most cases, there are two main problems. First, interest rates.
They came into the market when rates were very low. Interest rates then moved up quite significantly. The Reserve Bank lifted rates. The banks also expanded their margins.
Then there's the cost of living.
Over the last little while, the cost of living have risen quite dramatically, particularly for first-time buyers. And I'm thinking of the rates, I'm thinking of electricity, water and gas, I'm thinking of the other basic costs of living, and even childcare. So all of those are way above the CPI rates that are normally quoted.
We had electricity, water, land rates, everything just kind of piled on top of us at the same time.
When interest rates are low, they can only go in one direction, and that's upward. So you should always take into consideration with your due diligence an extra couple of percentage points for when interest rates do go up, so that you can plan forward. And of course, the rising costs of living these days.
While the latest drop in interest rates will certainly help home buyers, Newcastle real estate agent Wayne Stewart urges caution.
Over the last 5 or 6 years, we certainly haven't seen the capital growth in property that we may have seen consistently from 10 to 20 years ago. So I think that people who buy property expecting to make quick capital gains are buying property for the wrong reasons. Buying property is about long-term capital growth, it's about security for your family, it's about security in bricks and mortar, and that's the way it should be treated.
All done, all silent.
There are certain people who are saying that it's a great time to buy in the marketplace at the moment. I have my doubts about that, with unemployment potentially rising, with cost of living still rising quite dramatically for many people, and house prices on an absolute basis still much higher relative to income than they've ever been. So it may not be a really good time to buy at the moment.
Martin North believes his research indicates a broader trend and perhaps the end of Australia's property glory days.
I don't think we're ever going to see house prices back to where they were pre-GFC. I don't think we're going to see house prices back to where they were pre-GFC. I don't think we're going to see the lending environment the same, and I'm not sure that we're ever going to see property prices moving up as quickly, because previously people were able to get out of jail by selling their property at a profit. We're not seeing that now.
The Rouse family has at least managed to sell, and they can move in with relatives for a while. Cassandra Rouse hopes to return to work soon after maternity leave and has learnt from the experience.
I'm going to next time think about our situation and what can happen down the line. There could be illnesses, there could be something that my husband could be out of work, so we have to look at all the fine prints, I think.
Tracy Bowden reporting.